$5,000 a month, landing every single month without you selling a single share. Two different portfolios can both produce that. One needs about $323,000 invested. The other needs almost $2,857,000, nearly 9 times the money for the same paycheck. Grab the cheap option and you'll get your $5,000 a month for a while, pulled from an account that's quietly shrinking underneath you. Grab the expensive one and you'll be safe, but you'll wait decades before the checks start. Both are real answers. Neither is fast, because yield is just a fraction, and you can inflate any fraction by shrinking what sits underneath it. Here's what almost nobody explains. The biggest number on any dividend list usually isn't a sign of how generous a company is. It's a sign of how far its share price has already fallen. In the first 3 months of this year, one of the most recommended income investments online paid shareholders 36 cents a share, while its book value per share dropped 46 cents. Everyone who owned it collected a payment and still finished the quarter poorer. There's a third number sitting between the cheap trap and the slow, safe path, and almost nobody gets told it exists. Start with the fraction itself. Dividend yield is the annual payment divided by the share price. There are 2 ways that number can climb. The company raises its payment, which is what you want, or the price falls, which isn't, and the fraction reports the same result either way. When a business is struggling, its price usually drops first because markets react fast, while the payment gets cut later since boards move slowly. In that gap, the yield looks amazing, right when the business underneath it is weakest. So the highest yields on any screener come from 2 very different groups: a handful of solid businesses the market mispriced, and a lot heading toward a cut nobody's announced yet. From a ranked list, you can't tell them apart. The real first move is asking where the cash is coming from, and that answer sits on a document almost nobody reads: the fund's fact sheet. It lists 2 numbers people rarely place side by side. The trailing 12-month distribution shows what actually got paid out over the past year. The 30-day yield shows what the fund's holdings truly earned, after fees, over the most recent month. One is what went out, the other is what came in. Take one of the largest, oldest covered call funds in the country, one that sells call options against the S&P 500. Its fact sheet from late February showed a trailing distribution of 10.97%, but the actual earned yield was only 0.58%, a gap of over 10 points, meaning something like 95 cents of every dollar it paid out wasn't funded by earnings at all. That doesn't automatically make it a scam. The missing money comes from option premium, real cash paid for selling someone the right to buy your shares at a set price. But that premium isn't free. You get it by giving up your upside above that price. So every month the market rises, you hand back the gain and keep the fee. The cash shows up, the growth doesn't. Now meet Derek from the opening. He wanted $5,000 a month and didn't want to wait. So he sorted a list of income funds by yield and picked the top one, a mortgage REIT that borrows cheap and buys government-backed mortgage bonds. It advertised a yield of 18.55%, and at that rate, $60,000 a year needs about $323,000 invested, the cheap number from earlier. Derek wasn't scammed. The checks showed up exactly as promised, but the company's own quarterly report told a different story. 36 cents paid per share, book value down 46 cents, total return negative for the quarter. For every dollar Derek got paid, more than $1 of value quietly vanished. Judge it by the pattern rather than one quarter. The monthly payment has been cut repeatedly over the last few years, down more than a third, while the share price fell right alongside it, from around $7 to under $6.50. The dividend kept getting cut, the price kept falling, and the advertised yield stayed huge the entire time, because both sides of the fraction were collapsing together. Derek isn't getting $5,000 a month forever. He's getting a shrinking payment from a shrinking asset, and the number on his screen will look great right up until it doesn't. So, the obvious fix is to swing the other way, and that's Miles. He heard about Derek and wanted nothing to do with it. So he went looking for the safest income investment out there, and found the dividend aristocrats, companies that have raised their payout every year for at least 25 straight years, through every crash along the way. Nothing wrong with Miles's thinking. Something is wrong with the number he was given. You'll hear the aristocrats yield around 7%, constantly repeated online. But the actual fund that holds them yields about 2.1%, barely 2. At that rate, $60,000 a year takes nearly $2,857,000, the expensive number from the start. The safe path isn't slow because safe investments are naturally slow. It's slow because the yield is small, and a small yield means a mountain of capital before any real income begins. Miles didn't make a mistake. He made a trade, and the price of it is time. Here's the part that changes the whole answer, and it comes down to one structural choice most funds never advertise. With covered call funds, the strike price is everything. Older funds sell their calls right at the current share price, grabbing the biggest possible premium but handing away every bit of upside the moment the market moves higher. The oldest fund of this type, tracking the NASDAQ 100, launched around $25 a share in 2013. It's paid every single month since, without missing one, and it now trades near $18, a drop of roughly a third. Newer funds instead sell their calls above the current price. The premium collected is smaller, so the advertised yield looks lower, but the fund keeps every dollar of gain up to that higher strike, offsetting the drag from the payout. Several of these funds show zero or even positive price change since launch, while still paying monthly income the whole time. Same strategy, completely different outcome for your capital. That's the third door. The fund with the longest track record here currently pays 8.12%, meaning $60,000 a year needs roughly $739,000. A newer, more aggressive version pays 11.75%, needing about $511,000. So the third number isn't one figure. It's a range from around $511,000 to $739,000, depending on how much history you want backing it. Now put it in years, since that's the unit that matters. Say someone invests $2,000 a month, compounding at 6.5% a year, the 5-year average return of the Aristocrat Fund itself. Derek hits his $323,000 target in 9.8 years. Owen, through the third door, gets there between 13.4 and 17 years, depending on the fund. Miles reaches his nearly $3 million target in 33.5 years. Owen pays 4 to 7 extra years compared to Derek, and his capital isn't eroding underneath him. He still owns the asset producing the income. Miles pays 16 to 20 more years than Owen. For safety, Owen largely already has. One quick caveat. The more aggressive newer fund has only existed since 2022, so it's never lived through a real bear market, and option premium is usually taxed as ordinary income, not a qualified dividend. This isn't a recommendation to buy any specific fund, and I'm not a financial advisor. Before you buy anything for income, find the fact sheet, put the distribution rate next to the actual earned yield, and check what the share price has done since launch. That takes about 90 seconds and tells you more than any ranked list ever will. So, back to where this started. $323,000 and $2,857,000. Both producing the same $5,000 a month, nearly 9 times the capital for the identical paycheck. The gap was never about risk tolerance or discipline. It was about a fraction that can be propped up from underneath while looking exactly the same on paper. Derek gets his $5,000 a month, pulled from an asset that shrinks to pay him. Miles gets his too, decades from now. Owen gets there in between, years earlier than Miles, with the asset still intact. There's a fastest, honest way to live off dividends. It was just never the number sitting at the top of the list. My name is Mathan, and I spend way too much time thinking about how dividends can be used to replace your 9-to-5. Please show support for the channel and hit the subscribe button. It really helps, and it means a lot.